Legal in general is looking severely undervalued in the current market and also offers a yield of over 9%. In today's episode, we're going to take a look at why Legal in general needs to be on your watch list. We're going to run through the historical performance of the stock. We're going to do a deep dive into their income statement, looking at their total revenue top line as well as their bottom line net income. We're going to deep dive into their balance sheet, looking at the health of their balance sheet, their total cash versus their total debt. And we're going to take a look and see what are insiders doing. Are they buying or selling Legal in general? And this is going to lead us very nicely into some important financial metrics that you need to understand before investing into Legal in general itself. And as always, we will run it through our stock valuation model to get to our intrinsic value, our acceptable buy price given our investor margin of safety. Now, Legal in general is traded on essentially the UK London Stock Exchange, and therefore these prices, whilst they are in dollars, you can also buy them in GBP. It is down around 11% year to date towards the mid to lower end of the 52-week range with a yield of around 9%. Now, if we take a look at investors who have been holding the company over the last 10 years, you would be down around 18%. Now, whilst this isn't essentially what you want from any return on investment, in today's episode, we want to understand, is this severely undervalued, where we can see some very strong capital or share price appreciation over the next few years, as well as seeing our essential yield, double-digit yield on cost, 11, 12, 13, 14% over the next few years. Now, we're going to jump straight into the income statement and look at their essential revenue growth year on year. Now, typically what we look for is around 3 to 7% growth year on year on the top line. December 2018, they had around 14 billion of sales or revenue. But then when we look 5 years later, their latest annual report, they had around a loss on the top line of 13 billion. Now, before we get up to 2022 and discuss that, what we can see from 2018 to 2019, they had a lot of growth on the top line. It then reduced all the way down from 2019 to 2022. So not exactly what you want to see in any investment, but when we take a deep dive to understand exactly why this is, we can notice that the reason for this is essentially the net loss here in their interest and dividend income of around 25 billion. Now, when we touch upon this very quickly, what we can see is that Legal in general also has an investment management arm called LGEN, and therefore, due to the negative stock market movements, this led to their total income falling to negative 78.5 billion. And when you compare that to 2021, where they had a 35.9 billion profit or net income, you can see why exactly this has gone from essentially a net profit to a net loss, especially taking into effect the other arms of Legal in general. So assuming this is a one-off, it is still a slight worry given the fact that the top line has gone from a positive to essentially a negative. But how does that compare? Because it all does come down to that bottom line net income. Well, 2.3 billion net income reported in 2018. In 2022, 2.8 billion. So they have still managed to increase the bottom line net income in a positive way. And when we take a look, 2018 to 2019, we see a small increase before a decrease and then increasing again, remaining relatively flat. So fairly inconsistent in that top line and bottom line. But as we essentially move on to the balance sheet and do a quick review, essentially you could call it a health check of the company. We're looking at their total cash versus total debt. 2018, 22 billion sitting on the balance sheet. Latest quarterly report around 18.5 billion. So they are in fact holding a lower amount of cash on the balance sheet over the last 5 years, but still a very healthy position. Now, when we compare that to the total debt over the last 5 years, they had around 62 billion in 2018, and in their latest report around 43 billion. So it is positive to see that they have been reducing that total debt at a far greater rate than they have been reducing the total cash. So far the balance sheet looks okay. Now, in terms of insiders and how have they been trading, well, around 1% of the company is essentially owned by insiders. And what we can see over the last 12 months, they have been buying around £40,000 worth. And in terms of selling, around 823,000. So more selling than buying from insiders, with the largest sale around 823k in Q2 of this year. Another larger sale, however, this was last year at around 1.5 million. Now, just because insiders buy or sell, it doesn't necessarily mean we should copy their trades, and it is for us to do our own due diligence to make our own decisions. Now what we're going to do here is essentially a very quick look to see how they have compared against their competitors over a total return year to date in the last 5 years. We have companies here in the same industry, the life and health insurance, Principal Financial Group, Globe Life, Unum Group, and a few others to note. Well, over the last year to date, essentially, how has their total return been? Negative 2.86. Not great at all, but you can see it wasn't one of the worst performers. In fact, it was probably in the middle there compared to their competitors. Now, in terms of the last 5 years, how does Legal & General compare against the competitors? Well, what we can see, just straight away, a return of 17% over the last 5 years. Not really great. It's not what you want from any investment. You do want to see higher. And again, they are essentially in the middle of their investors, with the best performing being UNM, followed by PFG. As always, it's important to note that historic performance does not indicate anything around the future, but again, it is good to have as one additional layer of your review. So now moving on to the financial metrics of Legal & General Group, we can see the market cap around 16 billion, making a large cap company. Annual dividends around 5% increase year on year over the last 5 years, as well as the latest increase, with the last 20 years compounding at around 7%. Now, while this is positive, I would always say minimum you should be looking for is 4%, whether that's your essential dividends, other income producing assets, or your salary. Reason for this, the US inflation rate over the last 40 years was 4%. Anything less, you are in fact taking a pay cut and losing your purchasing power. But what I would say, given this is higher than inflation over the last 5 years and last 20 years, you are also locking in a very high yield, as we mentioned here, of over 9%. So very positive to see in that aspect so far. Now, in terms of the earnings payout ratio, again, with this industry, free cash flow is a lot more volatile, so we don't look at that, although normally I would prefer the free cash flow, as earnings is susceptible to manipulation by management through accounting. Personally, I prefer around 60% or below. It means, in my opinion, management have the ability to increase those dividends to double digits that we love to see. On the whole, though, it has been around that 60% consistently, with 60% in 21 and 56 in 22. Yes, we do see a slightly higher in 83% in 2020, but overall, I would say I'm personally happy with this earnings payout. Again, earnings per share, 15 cents in 2013, 36 and more than double over the last 10 years, although note it is coming down in 2023 to 22 cents. So whilst overall it's going in the right direction, we can see the inconsistencies where some years, as we see in 2019 to 20, it does seem to decrease. So bear that in mind with this company. Now, shares outstanding, we love it as investors when companies do share buybacks, returning excess cash to our pockets. And what we can see though, however, is the opposite. While 2013 to 2019 has remained relatively flat, from 2019 onwards, they have issued shares, which essentially dilutes your position as a shareholder. It's not a good thing at all, but you can see, it isn't that much. And again, they've only really done it once. But bear in mind, if they have done it once, if they do struggle in the future, they may be likely to do it again. ROIC, return on invested capital, one of my 7 golden dividend metrics, 10% plus is personally what I like to see. If you want to see the other 6 dividend metrics, do check the pinned YouTube video. Overall, this is slightly too low for my liking. What we can see from 2018 onwards, it has been between 2 to 4%. Ideally, I would like to see this go back up towards 10%, or at least make its way up. As we see in 2013, it was around 9%. Finally, net debt to earnings before interest, tax, depreciation, amortization. What this signals is the number of years it would take the company to pay off all of their debt net of cash on hand. While this may be a relatively high figure for the industry, I personally wouldn't like anything higher than 10. As we can see, overall it has been well above 10, especially in 2018 to 2020, but it has started to come down from then in 2022 at 13.18. The higher this is, the more likely it will be that essentially those dividends may not be continually paid, or the growth rate may not be as high as we would like. On the right, purely showing the percentage of a company's financing from debt as opposed to equity. As always, if you enjoy the content on the episode, smash that like button, hit the subscribe and bell button if you want to be continually notified of these videos. And as always, if you want to grab a copy of the valuation model to get your own intrinsic value and acceptable buy price for Legal & General or other companies in your portfolio, do click on the pinned comment below. Starting with Graham's valuation, and do note all of these will be in pound sterling, so if you want to translate, you can use FX rates. We have the stock ticker LGEN, the earnings per share at 32p, the growth rate per analyst estimates, and that current yield on AAA corporate bonds, giving an intrinsic value of £2.64. Now, currently in pounds, it is around £2.17, so this is some nice upside to the current trading price. We then move on to the multiples valuation model, companies in a similar sector and size. We have Standard Chartered, Schroders, and 3i Group. We have their stock price, earnings per share, P multiple, get the average, multiply by that of the EPS of LGEN, and get the stock price based on the multiples valuation of £3 and 2p. Again, above the current trading price of around £2.70, so lots of upside to the current price, and there you are locking in a very high yield as well. So there are signs of severe undervaluation based on the models we have just seen, but bear in mind we don't look at any of these models in isolation and will draw our conclusions towards the end of the episode. So the yearly dividends we see here, the average growth rate around 4.8%. Now I have gone a bit more conservative at 2%, and if you do want to essentially play around with this percentage, if you justify it higher or lower depending on your investment thesis and judgments, you can grab a copy of the model below. So based on 2%, the DDM price is £3.29, again higher than the current trading price of £2.17. So again, some strong upside in the third model. We then move to the fourth and final model, the discounted cash flow model, where we have the free cash flows year on year. Average growth rate negative 77%, with the forward-looking analysts estimating 2%. In conjunction with their discount rate, we get the present value of future free cash flows and terminal value. Add that with the cash, subtract total debt, and arrive at the equity value. Divide that by the shares outstanding to get a GB pre-price of £2.80, again showing severe undervaluation to the current trading price of £2.17. As always, the intrinsic value is the average of the values and the valuations we have just run through. And if you do enjoy the content, value is being provided, do let me know, smash that like button and hit that subscribe and bell button to be continually notified of these videos. So the intrinsic value at £3.11, and as I mentioned, the current price is £2.17, £2.18. So there is some significant upside based on our intrinsic value. Margin of safety, I would say 10% if you believe it has a wide moat, strong financial metrics and good forward-looking data. And that would mean a buy at around £2.80. For those looking at a 20% margin of safety, your buy would be at £2.49. And those looking at a 30% margin of safety, your acceptable buy would be essentially at the current trading price, signaling that based on today's judgments and estimates, you would essentially be receiving a margin of safety of 30% on the price of around £2.18. Now, Wall Street do forecast some nice upside to the current trading price to around £2.72 over the next 12 months, signaling some severe undervaluation. And don't forget, you are also locking in a very high yield at 9.1% whilst you are waiting for that share price to appreciate. As always, though, do let me know your thoughts in the comments below. Are you looking to buy LGEN, looking to sell, or purely on the sidelines speculating? As always, if you do want to grab a copy of the valuation model to run through your own companies, or even run through LGEN again to get your own intrinsic value and acceptable buy price, do click on the pinned comment below. And if you do want to join us over on the Discord, do click on the Patreon link below. We'd love to have you joining the community, discussing all things stock market related and finance. As always, have a great day. Catch you on the next episode and take care.